Central banks buy 77 tons of gold, helping the precious metal resist rising bond yields. Central banks elevate gold. Central banks boost gold resilience, a heartfelt look at the numbers. Central banks worldwide have been quietly amassing gold, infusing the precious metal with newfound vigor even as bond yields soar and the US dollar stands its ground. Their unrelenting appetite for gold continues to provide critical long-term support, and the recent numbers are nothing short of impressive. In August, central banks collectively purchased a substantial 77 tons of gold, marking a remarkable 38% increase from the previous month. To put it into perspective, in the last 3 months alone, these institutions have bought a whopping 219 tons of the coveted metal. This trend is more than a mere blip, it signifies a resolute trajectory of robust central bank demand throughout the year. Krishan Gopal, senior analyst at the World Gold Council, WGC, reflects on this surge in gold purchases with a sense of reassurance, stating, "This recent buying suggests that we have now firmly moved past the net selling we saw in April and May, which was primarily driven by heavy, non-strategic selling from Turkey. We are, therefore, confident that the long-term trend of healthy central bank demand remains in place." While the demand is robust, it's worth noting that this surge in gold purchasing has been largely limited to a select group of central banks. The People's Bank of China, in particular, has emerged as a dominant force, acquiring an impressive 29 tons of gold in August. This sustained buying spree began in November, resulting in the accumulation of 217 tons of gold, accounting for slightly over 4% of China's foreign reserves. Poland's National Bank is also making waves, snapping up 18 tons of gold last August. With a total purchase of 88 tons for the year, they are well on their way to meeting the 100-ton target announced back in 2021. This shift has bolstered Poland's gold reserves to 314 tons, amounting to a significant 11% of their foreign reserves. Turkey, on the other hand, continues its efforts to rebuild its gold reserves, having bought 15 tons in August, marking a stark contrast to its significant selling in April and May. The commitment is evident as they seek to regain lost ground. Other central banks joining this gold rush include Uzbekistan, which increased its gold reserves by 9 tons. The Reserve Bank of India, the Czech National Bank, and the Monetary Authority of Singapore each acquired 2 tons of the precious metal in August, contributing to the overall surge in central bank demand. The National Bank of the Kyrgyz Republic also entered the fray, purchasing 1 ton. The WGC, however, has noted an interesting development related to the Central Bank of Bolivia, which reportedly monetized 17 tons of its gold reserves, representing a potential 40% decline in gold reserves if confirmed. The nature of this monetization remains ambiguous, as it could encompass a variety of actions, from outright sales to swap agreements. The lack of data on gold reserves at the Central Bank of Bolivia beyond April further deepens the intrigue. In the backdrop of all these central bank actions, gold has been facing headwinds in the form of rising bond yields, which elevate the opportunity costs of holding non-yielding assets. 10-year yields recently reached 16-year highs, currently exceeding 4.7%. This week, 30-year notes yielded 5% for the first time since 2007, causing gold prices to dip below $1,900 per ounce. This challenging environment has led to a decline in investment demand for gold, with the world's largest gold-backed exchange-traded product, NYSE, GLD, experiencing its lowest levels of investment since August 2019. As a result, December gold futures are now testing critical support at $1,830 an ounce, with analysts suggesting that if this line is breached, prices could fall further to $1,800 an ounce. Despite these pressures, gold's resilience is remarkable, considering the prevailing bond yield conditions. Experts assert that, based on the economic climate, gold prices should theoretically be lower than $1,800. This resilience is largely attributed to the extraordinary influence of central bank demand, which has fundamentally reshaped the gold market. It is widely anticipated that this trend of central banks actively accumulating gold will persist. Nations across the globe are diversifying away from the US dollar, and gold remains their primary choice. It provides a buffer against the monetary turbulence spawned by the dollar's influence. This era of heightened gold purchases is a testament to the growing importance of gold in central banks' strategic portfolios. The World Gold Council's recent report on gold demand trends underscores the pivotal role central banks play in the precious metals market. As they continue to bolster their reserves, gold's fortunes remain intertwined with the unwavering support of these financial institutions. The figures don't lie, central banks are driving a new golden era in the world of finance. Thanks for watching. Like and subscribe now.